So what it means is that we are leaving the supply of basic commodities to the vouchers of market forces, and they will become, the consumers will certainly become vulnerable. So we believe that there can be a way that can be worked out to try and ensure that at least the suppliers and manufacturers of basic commodities, not to say other suppliers and other manufacturers do not require the same support, but basically we are saying, at least for the people of Zimbabwe, to continue to have a decent living. Ladies and gentlemen, I thank you. If we,
as retailers have bemoaned the shortage of foreign currency, or should I say low levels of foreign currency trading on the interbank market system, we just have a quick appreciation of where it is that the system has come from. Well, on the opening date, the RTGS was trading at $2.50 against the United States dollar. It has since weakened, moving right up to $3.14 as of today. And so what we see actually playing out in that particular case is a situation where those who've got the foreign currency feel that the rate there is too low compared to what you have playing out in the parallel market. According to today's stats, it shows that it is trading at about $4.30 thereabout, if you have to buy it at the parallel market. So this kind of a setup where those that hold the foreign currency feel that it's too low, this has actually resulted in low trade volumes actually recorded on the system. Deputy Minister of Industry and Trade, Honorable Raj Modi, called upon Zimbabweans to use local goods rather than spend on imports so as to alleviate forex shortages in the economy. Our Equity Access gives us the story. Let's listen.
Basically, we have a shortage of foreign currency because it's not enough for everything that we want to do. As the Zimbabwean people, we have that habit of, buying imported things. And they think the imported things is more better than our local one. But we need to change the mindset for people now to say, no, support our local industries, buy Zimbabwe.
Meanwhile, the RBZ is confident that yearly inflation will subside as month-on-month inflation has been coming off in recent months. This while adding that money supply has reduced significantly from the past. Deputy Head of Research at the RBZ, Dr. Mpunga, gives perspective on the subject. Let's listen.
In the morning, I heard that prices are still going up, but in terms of inflation, we are seeing that inflation is actually stabilizing. Because since November 2018, we have seen the month-on-month inflation, which I will show you in the next graph. We have seen that month-on-month inflation is actually been receding, which means that those inflationary pressures in the economy are receding. And some of the reasons explaining that decline in the month-on-month inflation are to do with the positive response to policy stimuli, especially the fiscal consolidation that government is undertaking. Because government is committed to reduce its deficit, which will also cascade into reduction in demand supply. Hence, that will cascade also into lower inflation. Then we have also seen some improvement in market confidence and reduced excessive speculation. Although there is still some speculation in the economy, but we have seen a reduction in that. And also I talked about reduction. In the morning, I heard that prices are still going up, but in terms of inflation, we are seeing that inflation is actually stabilizing. Because since November 2018, we have seen the month-on-month inflation, which I will show you in the next graph. We have seen that month-on-month inflation is actually been receding, which means that those inflationary pressures in the economy are receding. And some of the reasons explaining that decline in the month-on-month inflation are to do with the positive response to policy stimuli, especially the fiscal consolidation that government
That against what the IMF has projected, that they expect the inflation to reach 40% by year end. However, according to a just released Equity Access quarterly economic review as well as forecast, headline inflation is expected to close at 87%. Let's just have a quick appreciation of how inflation is actually played out. On the 1st of October, monetary policy statement is issued as well as a fiscal policy being issued on this particular date, and this brings with it seismic shifts in the economy. For the month of October, inflation is recorded at 5%. Moving right on to September, we record an inflation of 25.09%. Moving on to December, where inflation hits 31%. January 42%. February inflation moves right up to 56%, and now we just recently recorded an inflation of 59%. So these are the figures that we have playing out, and RBZ says they're confident we're going to see a single digit recorded. That's of course according to the Minister of Finance, Professor Mthuli Ncube, but that doesn't seem to tally with what the IMF says, 40%. Equity Access analysts say it's 87%. It remains to be seen how the story actually plays out in that regard. Moving on, the Standard Chartered Bank has been fined $18 million for violating the United States Department of the Treasury's Office of Foreign Assets, which is controls, which is the OFAC sanctions on Zimbabwe. The OFAC said the punishment is over 1,795 transactions worth close to US 77 million that were done by Standard Chartered Bank New York and Standard Chartered Bank Zimbabwe. The US $18 million is a part of a broader $639 million settlement between the Standard Bank and the OFAC as part of a combined $1.1 billion settlement with the federal, state, local and United Kingdom government partners. The London-based Standard Chartered paid $639 million for the Iran sanction violations, together with violations involving Cuba, Sudan, Burma, Syria, in what OFAC called that the global settlement. In other news, the South African arm of Nissan will spend 3 billion rand, which of course is $213 million, in equipping its local plant to build the Japanese car maker's new Navara model, the unit's boss said recently. Capacity at Nissan's plant in Roseland near Pretoria will increase by 30,000 units in the first phase, Mike Whitfield, managing director of Nissan South Africa, said, while the plant's permanent headcount will increase by 400. The Nissan South African Roseland facility will build the entire model range Nissan Navara for both local and export markets. Well, of course, this is a perspective on what has happened beyond the borders. MD of South African Operations Mike Whitfield sheds more light on the subject. Let's have a look.
Hi Yolanda, and afternoon to everyone. It's a fantastic opportunity not only for Nissan in South Africa and Africa, but I think also for South Africa. So the investment in total is 3 billion rand, and it'll be for the new Navara, which will go into full production in November next year. And amongst those investments, or the benefits, is that we will be creating a total of 1,200 jobs, 400 directly in this plant, another 800 in the value chain to supply the new Navara. In addition to that, we will launch at about 38% local content and very quickly get up to 48%, with obviously our aspirations to get closer to the 60% targets.
Okay.
We'll shortly take a break. When we come back from the break, we'll have news review with one of our analysts here at Equity Access. Please stay tuned. Welcome back, viewers. It's time for News Review, and joining me in studio for a conversation is our very own investment analyst, Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Good evening, Eben. Good evening, viewers.
Beautiful. Let's cut to the chase. Well, concerns they're raised by members of the Confederation of Retailers of Zimbabwe. Key issues being discussed being shortage of foreign currency, or should I say dryness, to quote what the president of the particular organization actually said, calling on better policies on part of the Reserve Bank of Zimbabwe. What is your comment where that is concerned?
Eben, I think the concerns by retailers, they are actually justified. If you look at the trades in the interbank market, there isn't been as high as expected. When we started the interbank market, the parallel market rate was at below, around 3, but it has since moved up to, the parallel market rate has moved up to 4.07, which is really showing, the weaknesses in the interbank market. If the interbank market was functioning as expected, we should be seeing trades happening much in the interbank rate, such that there won't be that constant rise in the interbank rate. But what we are seeing is a situation where the RBs that on its part wasn't prepared in terms of having sufficient reserves, to cushion the economy in terms of supplying the much needed forex. Then on the other part of exporters as well, we are seeing maybe they are also maybe matching the needs of those importers in terms of their forex allocations, such that not much is coming into the domestic economy. The settlement is being done outside the domestic economy. That's why you are seeing the economy hungry of the much needed forex. But what's really needed to be done is maybe to improve productivity of our local manufacturing sector.
Just to stop in your tracks right there, Tinashe. Look, Zimbabwe nearly recorded $5 billion, or should I say north of $4.4 billion in terms of exports in 2018. Juxtapose that to how Malawi is performing. Malawi has similar, a less figure in terms of exports, sitting at about $4 billion. But the economy is very much stable. The fundamentals are in place, and they don't have this forex concerns. But we're exporting so much, and yet we've got very little foreign currency actually circulating in the formal system. What do we have actually playing in this particular setup?
What you have to look at it's not that the just the export figure as it is. What you have to look at is to dig deeper into the net benefits of those exports. For instance, gold and tobacco, those are the major drivers of our forex earnings. And if you look at tobacco, last year it brings in about closer to $1 billion.
Yes.
But if you look at the setup of the tobacco, much of it's financed through loans, which needs to be repaid. So yes, you could have gotten your 5 billion, but you are paying back 4 billion in terms of loans. So your net benefit will only be just 1 billion. That's what's transpiring in the economy. We are net borrowers on balance.
Hold on a second. What do you mean when you say that we export 5 billion and then the much of it, about 4 billion is about loans? Hold on a second. We've got a setup in the tourism sector where we recorded $1 billion forex only. Okay, then we've got gold. We don't have loans in terms of gold. We only have loans in terms of perhaps tobacco as well as other commodities. Can you clarify that?
I give you one example in terms of tobacco, where we are saying out of the 1 billion that we have exported, 80% was financed through the contract system. And contract system, those are contract loans that need to be repaid offshore. So if you look at even the tobacco, the gold as well, they need much forex in terms of importing key production inputs, your cyanide and other equipment that might be needed in terms of production. So what you have to look at is on balance your requirement in terms of financing which is being done or which is financed on net through offshore loans. And at the same time, you also look at the level of your imports as well. We are highly import dependent, and maybe our imports for this year might even breach the 8 billion mark. So on balance, you are seeing it's an economy where your deficit is unsustainably high. So other economies that are not exporting as much, sometimes they've got a very strong domestic economy, and consumption in terms of those economies, they are consuming their local products rather than imports. For us, it's the other way around. There's little in terms of domestic products. We are consuming much of the foreign products. So on balance, there is net outflow of forex. I think that's the dynamics where that's happening at play. That's why you are seeing.
What would be the remedy? What would be the panacea to this situation?
First, I would propose, if you don't have a sufficient reserves to support your currency, what you have to do is stay away from intervening in the market, and maybe leave the market to find its own equilibrium. So at policy level, I think maybe the RBZ should just leave the market to itself, and I know the market will always find its own a desired equilibrium position.
Okay, in the same bracket of fundamentals, RBZ says inflation will stabilize. Your comment?
Yes, inflation might stabilize, but when you're saying stabilize, you have also maybe to quantify your statement. When you say stabilize, it might stabilize at 100%. That's stability, and it will stay at 100%. But I know from government perspective, they are saying inflation would drastically come down. But looking at what's happening in the economy, the price pressures, from the recently hiked producer prices for agri commodities, there are so much inflation pressures, and even the rapid shrinking supply curve. You are seeing there are so many shortages of local commodities. So for me to see inflation coming down this year is practically impossible, and even at policy level, the government or the RBZ might also be forced maybe even to expand its money supply emanating from the increased demand pressures for RTGS dollars and the likes. Maybe to explain a bit of what was happening in terms of inflation using this stat. Inflation started to shoot around September last year, when we had those uncertainties in terms of the monetary path that the economy will choose. But looking at the 59.4% figure for February, which was our dollarization high, or our post-dollarization high, it implies that it's an economy that is facing a serious weak fundamentals. And also the RBZ introduced this interbank market in February, and the interbank market and the hike in terms of the rapid depreciation of the local currency in the interbank market for February, it's not even factored in the February figure.
Hold on a second. Now Equity Access comes in and says that they expect the inflation to close at 87. IMF says at 40%. Can you shed more light where that is concerned? While Professor Mthuli Ncube says, wait a minute, we're going to record a single digit in that regard.
If you do a rough simulation, you may see that Professor Mthuli Ncube's projections for a single digit inflation might not be practical. If we assume that on a month-on-month basis, prices remain stable, there is no increase in month-on-month inflation, there is zero inflation month-on-month, inflation will only manage to fall by to 13%. there is no way it will go down to 13%. But the 0% month-on-month inflation, that's overly optimistic given the dynamics in the economy. So what we are projecting here as equity axis, we have seen elevated inflationary pressures emanating from persistent rise in fuel prices. You have seen retailers, on a daily basis, maybe increasing price of petrol by 1 cent or so. Those are actually, inflation pressures. Then the increase in producer prices for agri commodities, the producer price for maize was almost doubled from 390 per ton to around 726 per ton. All those will add up to your CPI, which will result in rapid increase in food inflation. So our projections, we are seeing
just to stop in your track there, we're just going to take a commercial break, then we're going to come back, we'll continue with our subject. Please stay glued to your screen. Welcome back. I'm still with Tinashe, an investment analyst at Equity Access. You were still explaining and wrapping up on inflation.
Yes, so we are projecting here inflation of 87.3%, and this 87.3% is driven by pressures from your food and non-alcoholic beverages. We think food and non-alcoholic beverages will actually surpass the 240% mark in terms of annual increases. The El Nino and the El Nino experienced drought actually affected our harvest, and we are thinking that food, our harvest won't be able to sustain local consumption needs or domestic consumption needs. So as such, there will be increased food pressures, which will help drive the overall CPI upwards to end the year at 87.3%.
Okay, to Mr. Pisin, who's the better prophet? Is it government? Is it Equity Access? Is it IMF in that regard? Then just quickly, Standard Bank, in the parent, of course, is fined US $18 million for engaging in trade in Zimbabwe. What is the implication of this?
Even this is actually a serious concern, especially to our economy, where US sanctions and EU sanctions are still at play. If you look at our history between the period 2009 to date, so far our banks, including Barclays, CBZ, have also been fined by OFAC due to all those issues to do with sanctions. So these issues, they actually increase the cost of doing business in the country, and you might see those correspondent banks actually shunning away or trying to avoid doing businesses with local banks in terms of offering those correspondent banking relationships and trade financing. So we might see an increased isolation of our nation and even our financial systems. This is actually a source of worry, and I hope our authorities maybe should have taken a proactive stance, maybe to engage the US and resolve the sanctions issue.
Well, thank you, Tinashe, for the perspectives. We will take a short break. When you come back, we'll have a look at the markets. Please stay glued to your screen. Welcome back, viewers. It's time for Markets Daily, and I'm joined in studio by our very own investment analyst, Anesu Chimbumu. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
As usual, can't want complain. Should only get better yourself.
I'm very fine. I would not expect anything from you.
Fantastic, fantastic. Let's get the ball rolling. Can you take us through the markets?
All right. Basically, the markets were green again today. 5 days stretching into today, coming up 0.63% for the all-share index, for it to settle at 125.82, while the industrials settled at 419.64 after adding about 0.62% to its level. Now, mining's index was the better reaching index today, coming up 1.1% for it to settle at 193.41, while the top 10 index added 0.23% for it to settle at 119.22. Now, the top 10 index is the weaker of all indices, coming up actually today, which is an anomaly for us, since the market has been pretty much directed by the top 10 index as of late. Now, top 10 index has the delta coming up the strongest, adding 0.54% for it to settle at 228.24 cents, while Econet inched up a little bit by coming up 0.02%. Now, Padenga, that counter did drop about 1.7%. This is why the top 10 index has a smaller margin in terms of growth today, because Padenga did come off pretty harshly today. Just to move on to have a look at our 5-day trend, the all-share index is now strong at a strong 2.16%, while the mining's index is now up 0.7%, consequent to today's increase. But today's increase has much to do with Riozem's performance rather than BNC. BNC was stable today, but Riozem, on the other hand, did inch up today, which was among 17 risers today, and we had about 3 counters that were coming off today, with 25 counters trading on the stock market today. Now, even though we had 25 counters that were slightly up from yesterday's 23 counters that traded, there was a decrease in terms of value that was traded on the stock market, coming off about 9% from yesterday's performance. So with that being said, RTG was the best performing counter of the 17 bulls on the stock market today, while African Sun did trail, coming up 11.31%. Just as well, PPC did add 7.58, almost mimicking that was NMB, coming up 7.31% for it to settle at 21.73 cents. Nampak did settle and curve the rises set by coming up 6.67% for it to settle at 32 cents. Now, Padenga, we've already spoken about that. Padenga is also looking into moving into a diversified market that is also just export oriented, which should improve their earnings in the future. But for now, I think a couple of profit taking investors did cause for this counter to come off a little bit today, while CBZ did let up 1.54% for it to settle at 17.27 cents. Cassava curving the laggard set as well. The forex market has continued to weaken, at $3.14 for the interbank market, while the parallel market is pretty much stable, for it to still trade at about $4.30, and the old mutual implied rate has has weakened today, consequent to a stable counter on the ZEC, while the Johannesburg Stock Exchange counter did come off today close to around about 1.5% from its prior session's performance. So that decline on the JSE did cause for the weakening of the old mutual implied rate today.
Well, thank you for the analysis, Anesu. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From Anesu and me, Donkey, and ciao.